Imagine turning a $1,000 investment into $1 million fortune without being a financial expert or relying on Wall Street analysts. Sounds impossible? Not for Peter Lynch. He's one of the most successful investors of all time, and in this video, we'll uncover the powerful strategies he used to beat the market. If you're serious about making smart investments, stay tuned. This could change your financial future forever. Who is Peter Lynch and why should you listen to him? Peter Lynch is not just any investor, he's a legend. As the manager of Fidelity's Magellan Fund from 1977 to 1990, he delivered an average annual return of 29%, one of the highest in investment history. To put that into perspective, if you had invested $10,000 with him at the beginning of his tenure, you'd have walked away with over $1 million by the time he retired. But Lynch's real genius wasn't just making money. It was his ability to simplify investing so that anyone could do it. No need for complicated charts or advanced financial degrees. His approach was simple. Invest in what you know. In this video, we're going to break down the most important strategies from One Up on Wall Street and show you how to apply them in real life, even if you're a beginner. Part 1. How to think like Peter Lynch. 1. The stock market is not just for the wealthy. Anyone can win. One of Lynch's core beliefs is that individual investors have a big advantage over Wall Street professionals. Why? Because they see trends before analysts do. For example, if you notice a new coffee shop always packed with customers, or a brand suddenly becoming super popular, you might have spotted a great investment opportunity before Wall Street catches on. You don't need inside information, you just need to pay attention to the world around you. And 2, the 6 types of stocks. Know what you're investing in. Lynch categorized stocks into 6 groups. Understanding these can help you pick the right investments. Slow growers, large, established companies with steady dividends but little growth. Stalwarts, medium growth, companies with solid, consistent growth but not explosive potential. Fast growers, high-risk, high-reward stocks that can multiply in value quickly. The cyclicals, companies like airlines or car manufacturers that perform well in good economies but suffer in downturns. Turnarounds, companies that were once successful but are struggling. If they recover, they can be huge winners. Asset plays, stocks that are undervalued because investors haven't realized their true worth yet. The key takeaway? Know what kind of stock you're buying. It's not just about numbers, it's about understanding the story behind the company. Part 2, Peter Lynch's smart investing rules. 1. Only invest in what you understand. Lynch's golden rule is, if you can't explain why you're investing in a stock in 2 minutes, don't buy it. You should know how a company makes money, its future growth potential, and why you believe it will succeed. If you don't, you're gambling, not investing. 2. Buy stocks that are cheap compared to their true value. Lynch didn't look for stocks that were just cheap. He looked for companies that were undervalued by the market. Sometimes, great companies experience temporary drops in stock price due to bad news or short-term fears. Smart investors recognize these opportunities and buy before the market corrects itself. 3. Stocks are not just numbers, they are businesses. Lynch viewed every stock as a story. If a company has a compelling story, like a revolutionary new product, an expanding customer base, or a unique advantage, it could be a fantastic investment. On the other hand, if a company has no real growth potential, no matter how cheap its stock is, it's not worth investing in. Always invest in companies with a story that makes sense. 4. Patience is the key to big profits. Most new investors fail because they get impatient. They buy stocks expecting quick profits, but when the price drops, they panic and sell. Lynch emphasized that the best stocks take time to grow. His biggest winners were stocks he held for years, not weeks or months. Investing is not a sprint, it's a marathon. Part 3. The most common investing mistakes to avoid. Even with a great strategy, many investors still fail because they make simple mistakes. Here are some of the biggest pitfalls Lynch warns against. Fear and greed. Selling when the market drops out of fear and buying when it's high due to greed is a recipe for disaster. Following the crowd. If everyone is chasing a stock, it's often too late to get in. The best investments are the ones nobody is talking about yet. Not doing research. Never invest just because someone gave you a tip. Spend time researching before putting your money into any stock. Lynch puts it simply. If you spend just 1 hour researching a stock before buying, your chances of success will increase dramatically. Part 4. How to become a successful investor. Like Peter Lynch. If you want to follow in Peter Lynch's footsteps, here's what you need to do. 1. Invest in companies you understand. 2. Look for hidden gems, great businesses that the market hasn't noticed yet. 3. Think long-term. Don't panic over short-term ups and downs. 4. Be patient. Wealth in the stock market comes from time, not timing. If you apply these principles, you'll have a much higher chance of achieving long-term financial success. Conclusion, your next steps? Investing isn't about luck. It's about knowledge, patience, and making smart decisions. The good news? You don't need to be a Wall Street expert to succeed. You just need to start. If you found this video helpful, don't forget to like, share, and subscribe so you never miss out on more investing insights. Thanks for watching, and I'll see you in the next video.